Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, March 10th, 2023. S&P 500 is currently sitting at 3890. I am David Zarling. I'm here with Ian Greenlawn McMillan. Pretty important week as far as developments in the banking sector this week, Ian.
Yeah.
Probably worth starting there.
Important in a not good way, unfortunately. So had a pretty big hit to regional banks yesterday, which, from a relative perspective, hadn't been the strongest. But yeah, that certainly had a ripple effect.
Yeah, absolutely.
Especially across small caps. So not many, if any, regional banks in the NASDAQ 100. As most of our listeners know, that's a pretty large cap growth tech centric index. But when we look at an index like the Russell 2000, almost the opposite end of the spectrum, a lot more stocks. It's a value index, smaller companies. Yes, regional banks are a big part of that, and it was not pretty.
One of the main drivers of that was SVB, Silicon Valley Bank Financial Group, just went into receivership today. Bank has been shut down, protected by the FDIC. It's the second largest bank failure in U.S. history. And everybody wants to know, is this the Lehman moment? And guess what? No one knows, right? Recency bias from the previous financial crisis. You hear the term Lehman Brothers, bankruptcy and failing. That doesn't make you feel too good, warm and fuzzy. But sometimes there's cognitive dissonance and we're looking in the wrong direction. And maybe it is and maybe it isn't. But Price was showing us beforehand that Silicon Valley Bank was not in a good position. It's not like this was a rogue wave event.
Most technicians would have asked you why you would have owned it yesterday in the first place.
Because it was in a downtrend.
And had been in a downtrend for over a year. I mean, it broke its 200-day last year with everything else. Before yesterday, it was already 65. It had gone through a 75% drawdown and was 65% off its 2022 highs.
Before yesterday.
Yesterday down another 60%. Today, I don't know. They closed the bank. So I don't know. David and I were discussing this before we hopped on the podcast. I don't know. Is it a Russia thing where it just goes away or how this gets resolved? But
not trading.
For all intents and purposes, Silicon Valley Bank, the number one rating in KRE, which was, there's a couple regional bank ETFs, but KRE, one that we're very familiar with, the one that, we typically use on our team to look at quote unquote regional banks as a whole, was the number one weighting, 2.5%. And I know that doesn't sound large, but when we talk about there's 150 stocks in that ETF, it had a very significant oversized position compared to a lot of others.
One of the things that was significant regarding Lehman Brothers was it wasn't just Lehman Brothers. It was the contagion that took place, the counterparty risk that took place. And so that's the somewhat unknown right now. But we know, because we study what's inside of these ETFs, that Silicon Valley is not the only one that was having issues from a price perspective. And we could just go year to date. And there's been, whether it's Western Alliance, which is down decently today. Many people are familiar with Silvergate Capital just because of its really tight ties to crypto. And you can't help but wonder what some of the contagion was coming out of the FTX bankruptcy, a story that seems to have just evaporated, but maybe is rearing its head again. As we talked about, SVB Financial, Silicon Valley, of course, going into receivership, but First Republic, PacWest, Signature Bank. So not all regional banks are created the same. the reason why I can say that is during that same time frame, you had other banks that were up or down less.
So you had Western Alliance and you had Pac West. And what were the others, Dave?
If we look at year to date and what went on like to the downside, Silvergate, Silicon Valley, Western Alliance, Pac West, First Republic, Signature Bank, these are the areas that have been hit the hardest in the regional bank area. And some more than others. I don't pretend to know all the ties, have ties to crypto.
So I'm assuming Western Alliance is a West Coast bank.
It's out of Phoenix.
And I'm assuming Pac West is a West Coast bank. And First Republic seems to be based out of San Francisco. Silicon Valley, I'm assuming that's pretty obvious. We've even had a couple regional banks that went green this morning. But yet we're on day 2 of this, and you're naming off some regional banks that are down another 25, 30, 35%, 50%, and some Western Alliance. Definitely seems to have a geographic flair to it.
Yeah, definitely tied to the Silicon Valley area, the West Coast. That's not to hammer on any people. People at those banks, I'm sure, are good people. I don't know what their risk metrics are, but there's definitely pain in regional banking on that side of the country. And the fact that you would have this, the 18th largest bank by assets, Silicon Valley, approximately 212 billion, go into receivership and go under FDIC protection, which is good, right? It's good to have these protections in place, but it does have you wondering where the counterparty risk is. And there does seem to be some counterparty risk in these other names that we just mentioned. So time will tell. Definitely regional banking is, as a whole, is hurting some. I think of a couple of the regional banks that are inside the Adaptiv Select ETF. They weren't immune to selling, but they also didn't have
down about half of what the overall
Right.
index did yesterday.
Right. So they were the relative leaders. And so that shows the momentum and relative strength that is the backing of that ETF were effective in overcoming that avalanche of selling across that industry to show that relative strength is a good thing. So we have that as a backdrop. The broad market as well, below, using something like the S&P 500, now below its 200-day moving average. The NASDAQ 100, using the Qs, is right there.
Russell 2000 back below.
Well, and that goes back to
Dow back below.
how well are small caps going to do if regional banks are doing poorly?
Yeah.
We've talked about value and its strength recently, but not all areas of value are the same. People would throw regional banking or regional bank stocks as value stocks. Now, I know that there's been some rearranging of things like energy and tech, but when you look at small caps, 15% of small caps using IWM is financials. There's information there. Or you look at something like just a value fund like SPY-V, and you notice that financials is the largest weighting, 19%. And when you look at year to date, what's going on, it's definitely financials that are holding that up. Whereas you have value still in industrials, right? Industrials still held up during this. That's notable to pay attention to. I'm not saying they weren't sold. They were just sold less.
Industrials still above their 200-day. Materials still above their 200-day. I would put that in the value bucket. Healthcare below its 200-day. I guess that's value. Some people, they put in a third bucket defensives. Healthcare has been bad for like months.
Right.
I think it's had one green week in the last, no, not even. One green week in the last.
Well, and healthcare is a mixed bag, right? In some ways it's value, in some ways it's safety, right? It can be a risk-off area, but it also has an element of biotech, which is a risk-on area.
Biotech, also a big component of Russell 2000, back below its 200, if you're using IBB, or they might all the biotechs ETFs might be back below their 200-day, but for sure IBB is. So yeah, some weakening under the surface.
Yeah, banks are 9% of IWM, and biotechnology is almost 7%. And those are some pretty big pretty big areas of small caps that are now in jeopardy, right? When you look at small caps overall and you look at something like volume weighted average price, right? We're below now volume weighted average price from the COVID low. We're below all the volume weighted average price from each important high during the lower highs during the downtrend that's taken place since.
And this is on the Russell 2000?
Yes.
Okay.
And when we look at that, those are important levels. Yes, the 200-day, we're below that. You'd like to see that hold. But also the fact that when we look at that VWAPs, we're below the COVID low VWAP and we're below the October of 22 VWAP. So this is a really important area, and S&P is right there as well as being at an important area. It's right at the VWAP average, the volume weighted average price from the October low of 22, the June low of 22, and the May 22 low. It's an important area.
It's a very important area.
I know some good technicians that pointed out that we've had 2 90% down days going back into February. And it just so happened that those 2 90% down days happened at the 40-50 level. Approximately, that goes back to that close to that 40-80. But that was on, well, most recently, March 9th. But then again, also on what I believe was February 7th. I've got to look back. But there's 2 days.
I think it was March 7th and February 21st. I think that's what you said yesterday.
Yeah. So those 2 dates happen right at the same.
Yeah, right at 40. And both of those were right at 40-50.
Right at 40-50, which if our listeners remember us talking about the importance of the 40-80 to 41-80 level, and that dates back to June of 2022 and most recently January of 23. And this is happening after record breadth thrusts in January. But admittedly, this is the weakest response we've seen after like a Whaley breadth thrust on record. So the Whaley breadth thrust that happens in January, when we look back at previous Whaley breadth thrusts and what happens after, this is the weakest response afterwards that we've ever seen.
Wow. Yeah, and it seemed to be taking shape, and we had a good January. Everything, is kind of stalled out. Yesterday was also a 95% down day, the 7th and the 21st.
It's important to take note of these things and understand the significance of important price levels. It's just simple math. If we can't stay above a 200-day moving average, things were looking promising being above a 200-day moving average, being above 40-80. But now that we're back below those levels, clients will be familiar with how much cash has been raised this week because of that environment. And is it risk off behavior again? We still need to wait for additional information from price. And I think it's important that this VWAP level that we've been talking about, which is approximately 3870, 3850 on the S&P 500, those are important to pay attention to as whether we're going to hold. You could use the Qs 291, extremely important to hold that area. Just frankly, small caps need to reclaim their 200-day moving average. And so until that happens, we're back in this range that's been going on since May. And the old adage, right? If they don't scare you out, they'll wear you out. And so you had a 20% sum decline last year in many indices, and then you move sideways in a 20% range. That's a scare you out and wear you out scenario. And it's hard for trend following in that type of environment.
Trend following, right? Most technicians would tell you a flat 200-day is something that you would like to avoid. And I would say that we are getting that on most major indices. Obviously, the Dow has been there. I would say the S&P flattening out, Q's getting there. And I don't see the flat 200 days necessarily ending anytime soon. So, a good chance to stay sloppy over the coming weeks and months.
Right. It doesn't have to turn into a capitulation event. It might. Some Ellioticians would point to that this is the possibility of 3 of 3.
Mm-hmm.
And that would be the fastest of the moves. That doesn't have to be how this plays out. And really, it's just simple math. If we're above certain levels, that means buyers have control. And we're below certain levels, sellers have control. And so caution is warranted in the current tape, identifying where
when did Lehman do you remember at what point the Lehman news broke?
I believe it was September of
08.
08.
So markets had been drifting lower for a while. And then you have your October, right? You have your October and your November, which is...
Bankruptcy of Lehman Brothers was September 15th, 2008. And the S&P, by that time, had already corrected, let me do this quick math, from all-time highs, which were in October of 07 to September of 08, the market had already corrected 20%.
Yeah, seems about right.
And then that's where the aggressive decline began. And at the time, what I recall was, okay, the market had priced this in. And so whether Silicon Valley is a Lehman Brothers event, I don't know, but we can use price to guide us in that risk management protocol. Right below a 200-day moving average, things change. And it's a flat 200-day, so it could be messy. We're up against...
Could be messy. We did not have a flat 200-day in September 08.
Right. It was already in a downtrend, correct?
Mm-hmm. Mm-hmm.
And so time will tell. And we had record shorts going into September and October of last year.
Record shorts. Where do I buy those at?
Yeah, at the record store. Record store shorts. It was a record level of people shorting the market. The market moves higher, causes some short covering in January. In fact, record short covering. And now we're still in this middle of the range that goes back to May of 2022, exactly in the middle of it. And at these important volume weighted average prices from important bottoms. Now, the canary here, though, is regional banks. Like, yes, on one hand, you could say, how bad are things if we're seeing things, some strength out of, maybe some unique international spots. But you also don't get to ignore weakness in regional banks, and that could be problematic.
And this has also found its way over to European banks. So an area that had held up strongly, rolling, they've broken this range that they've been in. Right here at like the $19, $20, $19.50 for using EUFN. I know it's European financials, but for all intents and purposes, we're going to use it to represent European banks. Yeah, I don't think you can ignore, like, the banking system's important to the stock market.
Yep.
Do I think that what happened in Silicon Valley is going to affect small town suburban community bank? I don't know.
Yeah, there's no way to know.
As someone with just as much knowledge on that as other people listening, I would guess not. But from a stock market's perspective, regional banks are definitely an area that people like to check out for a risk on, risk off attitude. Or they need to be working, right? That's kind of the thing. They don't need to outperform.
Right.
Like your I know JP Morgan, clearly not a regional bank. But banks in general, always a good sign when financials and banks are participating.
It doesn't give you the warm and fuzzies when sellers are doing this to regional banks.
No.
I don't want to make light of it. I also don't want to raise undue alarm bells because the balance sheet construction of banks between the great financial crisis and now has dramatically changed. And it's why we use price to begin with. Do I think you should be involved with regional banks right now from an investment standpoint? Absolutely not. There's plenty of those banks that are in downtrends. If you're going to be involved in them, there's ones that are easily identified with relative strength. And that's why you use ratios and you use momentum to identify those pieces. But some of these West Coast banks, I think they're hands off for now until price proves otherwise.
This is why no one gives media rights to the Pac-12.
Exactly. Yeah, right. I don't know if you'd call this a West Coast bank, but Credit Suisse.
It's far West Coast.
Yeah,
so far to
all the way around. Yeah, you got to go all the way to the west. Just keep going.
That's cruising towards zero.
Just keep going. And it's sitting at $2.69. And some people would be like, oh, that's a deal. It's a low price for a reason.
Yeah.
And it's in a downtrend. So not all European financials are the same. but it goes to show that 1 week's worth of information can be hugely valuable. And we got some of that this week. Some of it's hard from an indices standpoint, right? You're still in the same range. So in essence, it's called 10 months. We've been doing podcasts with price in a 20% range. It's not really all that exciting. It's not like we can provide you a tremendous amount
It's
of
quite
information
frustrating. I wish we could come on here
and have a new trend in place.
and this was Q4 2020 or Q4 2019 or pretty much any other period since we've started the podcast other than the last 10 months.
Right.
And I would say the last 3 to 4, right? Because you don't even know in May, like, hey, podcast is going to get real boring going forward because we're going to go into a sideways range. But yeah, after months of sitting here talking about 40, 80, and 4180, ready for a trend.
Yeah. And the trend can be up or it can be down. And we have a game plan for both.
You don't get to pick a hand you're dealt. I wish.
Right.
There's really no folding. I mean, I guess moving to cash, if you wanted to call it that, or there's things you can do. But once the river comes out, it is what it is.
Exactly. It just goes to show that it goes back to the market, right? We haven't seen a 20% range like this going back decades. And markets are fat tails, meaning when you look at a distribution curve, like a bell curve of events, it consistently has fat tail events, and they can be both sides. They can be positive and they can be negative. So for example, what happened with Silvergate from a price perspective, from a Silicon Valley Bank from a price perspective, those were fat tail events yesterday. At the same time, can we identify using price and charts when the likelihood of fat tail events start to increase? We can, right? Both of those stocks were in tremendous downtrends, hands off, meaning 200-day declining, 50-day declining, lower highs and lower lows consistently, consistent underperformer versus the indice as a whole, consistent underperformer versus the region or the subsector as a whole. Like, these are not mysteries when you start to see downtrends and then these type of moves that are fat tail, they're outsized events. But sometimes that it's going to rain when you've got clouds and thunder.
As far as your comment on a 10-month range we've been in to this extent. So some might say 2015, 2016, I would agree with you that at least you got like some trends in there. The 2011 bottom and all that mess, that was only 4 or 5 months.
Right.
The summer 2010, that was only like 4 months.
Well, and 2011 was a 10% range. 2010 was a 10% range. 2015, 2016 was a 12% range. Even your topping process in 08 was a 12% range. 708. Your bottoming process in 2002, 2003, that's about the equivalent.
Yeah, it's down 20, 21%.
About a 20% range. So it's something we haven't seen in 20 years. And that's okay. That's markets.
I mean, even 94, 95, I guess that was a majority of 94. That was 10%.
The 1974, 75 bottoming process, that was about 20% range. The 1970 bottoming process was about a 12% range. 1966 bottoming process was about a 10% range. So we're definitely in the fat tail environment. If this is a bottom, to be determined, it's one of the more historic bottoming processes that we've seen from a market perspective.
Whatever it is, it's historic.
As you've said, every year the market does something historical.
This goes along with your note on the Whaley bread thrusts. We have seen a lot of data over the last few months. This has never happened in a bear market. This type of thrust, or when the advanced decline line goes from, and I'm not picking on any of the, this is absolutely not me picking on people that have pointed it out, right? These are signals, and a lot of them are good, strong signals that have some of them perfect track records going back 40, 50 years. A lot of them went off, some in Q4, a lot in January. And there's the potential now for all of those to now get their first time not working out, maybe. I don't know the best way to word that, but there's a first for everything.
Yeah, correct. There's nothing new under the sun, and sometimes the nothing new can be extreme. And markets are extremes. And that's just the reality. Like, if you think you're going to go through life without any storms, whether literally or metaphorically, markets are no different. You're going to have environments. And it's an interesting dynamic between the record shorting going on in October, the record short covering going on in January. And then as you head into February, you had a record amount of single stock call option volumes. That was February 5th, and that comes from Goldman Sachs trading desk and Carl Quintanilla, that single stock call option volumes, the highest volume day ever.
And that was the top of this latest rally we had.
Right. So you got all the shorts out. All the shorts got squeezed. Tons of people went in with buying calls, and we've done nothing but correct since. And now we've seen some regional banks in trouble. It's not a great scenario.
No.
And clients will be familiar with the amount of cash that's been raised this week, right? Because cash is a position too. It's a place to be. We don't have to be fully invested unless we're above 40.80 and 41.80. So those continue to be.
Yeah, and then we'll talk about being bullish on stocks, but
if you force the shorts out and you brought in the speculative call option volumes to record levels around the same time, that has that, like, obviously it's not a blow off top because we're not at new highs and this is happening, but that's the type of behavior you see at those type of speculative. There's plenty of people that are still operating in their Robinhood accounts, trying to play the stock market game. It's an interesting time, whether it's TikTok videos and how you need to invest. We'll see how this all plays out. I don't want to be so, like Debbie Downer, because there are still areas that are interesting that have kind of held up, like semiconductors. And so there's evidence on both sides of the scale at this point where you don't want to see regional banks sell off. But the fact that semiconductors held up and industrials held up, that's not terrible either. And you've got whether it's staples or utilities, your safe havens, they're also falling, but you are in a scenario where, like, for something like XLP versus S&P, held an important level from a ratio standpoint and is moving higher. And that is risk off behavior. Or seeing treasuries finally go the opposite direction, moving higher while stocks are moving lower. Typically they had been moving in concert for well over a year now, where they were both moving down together. And so maybe now this is truly a risk off bid taking place. And I know Dan highlighted that this morning on our team, that maybe treasuries are actually getting a risk off demand while stocks sell off. We'll see.
Yeah, very possible.
And so we've seen some damage in the value area because of regional banks, right? Not all value areas are the same. We kind of covered that. What are we seeing from a growth versus value, or maybe like a NASDAQ 100 or tech?
Yeah, I mean, so you mentioned the NASDAQ earlier. It's the one index holding its 200. I mean, we'll see. It's sitting right there, actually on the cusp of, what do they call, a 50, 200-day cross, a golden cross.
Wait, what's the? So they make it dramatic. It's the golden cross to the up
and the death cross.
The death cross.
I guess you're close there.
And you're talking about growth versus tech. Are you talking?
I was talking about the Qs in general, and that's always a pretty bad signal, especially short term.
Yeah.
On whether.
Oh, you're just saying that the 50-day is close to crossing the golden cross above the 200-day.
I think it's close.
Yeah, it is close.
I just happen to have them both up.
It's happening right now.
Dow, which was the darling for 2022, obviously a big value index. It's just a bunch of large cap, blue chip household names. Definitely been the weakest so far. I mean, really, and the Dow peaked back early December. So think about that. While we talked about the S&P peaking February 5th, Dave.
Right.
just a few minutes ago. The Dow peaked November 30th.
That's that mixed. It makes sense with the largest weighting being now a headwind. It had been a tailwind, but you look at United Healthcare
United Health, new lows.
and also on a relative basis versus the Dow Jones, it's leading to the downside. It had a death cross.
It did have a death cross.
Maybe
Rallies immediately after, but yeah, it's not looking good. I mean, I don't see. In fact, from a breadth perspective, I think that we're back to like 600 stocks on new 8-week lows. It was a nasty thrust to the downside yesterday. In a market that, this didn't happen in a strong uptrend. It happened in a market that I would say really couldn't afford something like this to happen underneath the surface. The market was kind of already limping along, and someone came out of the woods and just leg swiped the regional banks.
Yep, there was promising, and there still are. I don't want to make it sound like all promising signs are gone. And I'll go back to semiconductors as being that example.
Yeah, semis.
But your point is spot on that just as it appeared that potentially a new uptrend was upon us, Lucy yanked the football from Charlie Brown, and that football was regional banks.
It was.
And took value with it. And that's why and small caps. And that's why it matters to look underneath the surface at value. Like, value is not just one place. There's pieces of value. And regional banks, we didn't have any exposure there other than two, and they had few that in the ETF that actually happened to be relative outperformers. And that's a
non-discretionary, system.
Right.
So
right. It is what it is. It's the system that operates. And when we look at all the evidence of did the relationship with treasuries and stocks just revert back to treasuries up is risk off, and we just saw credit sensitive areas like regional banks sell off, we should take that information in and sit up and take notice.
I agree.
When I look at CCC credit spreads, which is another liquidity diagnosis instrument, it's flattened out here. It's been in an uptrend. And when credit spreads rise, it signifies tightening of liquidity. And we've been rising since July of 21. Of course, we know that now. You don't know that as of July of 21. We had been falling since October, right? Which means an increase of liquidity, and that's oxygen for a market.
Mm-hmm.
We're starting to see that curl back up, and it's going to be interesting to monitor that and also be aware that there's other dynamics at play there. You've highlighted in the past that CCC credit is very small cap energy.
And the energy continues to hold on.
And so if there's things happening, if you think of the weighting, right, just like an S&P has a weighting or the small caps have a weighting or NASDAQ 100 have a weighting, if you look at the weighting of CCC credit spreads, it's typically in many instruments overweighted towards energy CCC. So would that possibly mask some of the other tightening of credit going on elsewhere? Only time will tell. We'll have to wait and see. I get it. Like, that frustrates people because they want a prediction. But the minute you get into prediction, it becomes problematic because you marry it with your ego. We don't really manage portfolios with ego around here. That's just not our style. We're going to use price instead because price is the most recent information we can find, and it's a future discounting mechanism. And really, if broad markets, we don't talk about the NYSE composite all that much, but the fact that we're back below November highs and we're back below a 200-day moving average, if NYA can't hold the 14,900 level, that's guilty until proven innocent.
Indeed.
And this week we saw cryptos sell off as well, Ian.
Yeah, and back to those 2017 highs, I believe, around 19,000.
So you're using Bitcoin?
Yeah, I think Bitcoin is sitting right at 19,600.
Right at its 200-day moving average, which is flat.
Right at its 200-day, also very flat.
And so
very flat
200-day moving averages are messy, as Ian already alluded to. And so you can expect that, and you'd want Bitcoin to hold on to that. And I don't think we get to be surprised on any connection between crypto and some of these West Coast banks. again, time will tell. What haven't we covered, Ian, that we should cover before we wrap this up?
Not much. I mean, it is wait and see. We're back on the negative side of the 50-yard line from a price perspective. Bullish percent remains also back in bears' hands, right? Anything can happen. Maybe we get a huge rally through the rest of March, and by April, no one even remembers Silicon Valley Bank. That is as you would say, a non-zero chance. But I think we've just, as far as I'm concerned, is, we just remain in a wait and see mode. And from an allocation standpoint, you are definitely more protective.
Yeah, it is an environment that if you're using something like the S&P, you really want to see this most recent potential higher low. It's not a higher low until we exceed 4,300, but you really want to see 3,780. Below 3,780, there's really no need to be involved with stocks.
Yeah, that swing low from late December, which was about the last time we had, Brett, that looked this bad from a 50-day moving average standpoint. I put a stat on Twitter today. Only 10 of the 11 sectors, so only one of the 11 sectors, I'll phrase it that way, has a majority of constituents above their 50-day moving average. And the last time we saw that was also late December. So from a mentality and what's going on under the surface, that makes sense. We're basically, how far away are we from there? That would be another 2% lower, essentially.
Right.
I don't know so the Russell is also not below its December lows, or that, that range I get bases a lot of these things created. It's actually still has another 3%, a little over 3% to go. And the Dow, I don't really know if the Dow ever had. It is. So late Dow consolidation, the Dow is below those. So in that essence, the Dow Jones also, yet again, the weakest.
The weakest. I would also add that, besides regional banks, you're seeing it kind of a little bit across financials, whether it's insurance, those type of areas also getting hit, your biotech, which we talked about, and then your higher risk, like ARC type funds rolling back over on a relative basis, which a lot of investment in some of that came from the West Coast. Sorry to be coming down on the West Coast, but I heard they're out of U-Hauls to move. And, we're going to see how all this plays out. But, the great Warren Buffett always said, when the tide goes out, we're going to see who's swimming naked. I'm not trying to be flippant, actually, because, right, there's real people with real lives that have real jobs at these places. And there's real economies that affect real people. But as a capitalist, there is consequences for poor behavior and poor due diligence. And if that's what's taking place right now, while painful now, we come out stronger on the other side. We'll see where this all plays out. We'll see what the next data brings. But this was definitely, this week, specifically yesterday, was a shot across the bow for any evidence for the bullish case.
It was.
Equities as a whole. And caution is warranted. Clients are aware that there's higher levels of cash going into this weekend that they've seen in a few months, and that's appropriate. And we know that we have Adaptiv Select ETF that has built-in risk management protocols that if we get a 5-day moving average below a 200-day moving average on a Friday, may not happen this week, but it might be next week. That's going to protect that instrument as well. Anything else, Ian, before we wrap this up and head it off to the editors?
Not from me.
All right. Ian, you have a wonderful Friday. Everybody listening, we really appreciate it. Big week, potentially, that we can look back at as a mile marker for this market. If you like what you're hearing and listening, if you find it valuable, we would love it if you shared it and gave us high rankings. that helps us get the word out, and it's a way of paying us back, and we appreciate it. Speaking of paying back, this weekend is Drives for Lives, Ian. It's a charity event that we're doing next Friday, March 17th, St. Patrick's Day. Who doesn't love watching March Madness and golfing at the same time in a simulator? It's going to be a great event. And if you're interested in supporting that event, you can go to beatsforheartbeats.com, click on Drives for Lives. And if you'd like to support, we would love it. Otherwise, take care.
Have a great weekend, everyone.